In this video, we're going to learn about the bond's trading status, which is a function of the bond's price and par. Bonds can trade at a premium, discount, or par. How do we determine whether a bond trades at premium, discount, or par? Like I said, the trading status is a function of the price and the par, such that if the price is greater than the par, we say that the bond trades at a premium, because you're paying a premium relative to the par. If, on the other hand, the price is equal to the par, then we say that the bond trades at par. Finally, if the price is lesser than the par, then we say that the bond trades at a discount, because you're paying less than the par value. Let's look at an example to make sure that we really understand this. So here we've got three bonds, which I've just conveniently called A, B, and C. All three bonds have a par value of $1,000, and their prices are $963.53 for A, $1,000 for B, and $1,241.97 for C. It's a good idea to pause the video right now and see if you can identify which bond is trading at a par, which one's trading at premium, and which one's trading at a discount. Hopefully it's quite clear that A is trading at a discount, B at par, and C at a premium, right? Because A's price is lesser than the par, so it's trading at a discount. B's price is equal to the par, so it's trading at par. And finally, C's price is greater than the par, so it's trading at a premium. In terms of why this information is useful, generally speaking, premium bonds are less risky and discount bonds are more risky. So if you see two bonds and one is trading at a premium and the other is trading at a discount, you know which one's more risky than the other. And depending on your risk tolerance and your risk attitude, you can choose accordingly. Regardless of what you choose though, it's important that you know that when you buy a bond that's trading at a discount, it doesn't mean that you've made a good deal. It doesn't mean that you've got a bargain. Similarly, if you were to buy a bond at a premium, it doesn't mean that you've made a bad deal, and it doesn't mean that you've overpaid for something. And that's because a bond's price is a function of its inherent risks and rewards. If a bond trades at a discount, it's trading at that for a reason, because it's highly risky. Similarly, if a bond trades at a premium, it's trading at that for a reason, and that's because it's less risky. We're going to talk about the risks and rewards in great detail in the next section when we go over the fundamentals. For now, I want to talk about something that's quite interesting, which is that regardless of the bond's trading status, so regardless of whether it's trading at a premium, par, or discount, all bonds will converge to the par value at maturity. This is really important. So at maturity, the price of a bond P will always be equal to par for every single bond, regardless of whether it's trading at a premium, discount, or par. It doesn't matter. To show you what I mean, let's graph this out. So what you've got here is the price of the bond on the y-axis and the time to maturity, or N, on the x-axis, and you can see that the par value is $1,000. If we were to plot out the price of a premium bond from today through to maturity, this is what you'd have, right? So the price is sort of fluctuating over time, it's steadily decreasing, and then it gets to maturity and it reaches $1,000, right? So the price of this premium bond has converged to the par value. Now, if we do exactly the same thing for a discount bond and plot out the price of a discount bond, then you'd have something like this. So you'd have the price still quite reasonably volatile and increasing steadily and converging ultimately to the par value of $1,000. If the bond traded at par, of course, it would just remain next to the par value and ultimately converge to the par value itself. So clearly then, it doesn't matter whether the bond was trading at a premium, par, or discount, it converged to the par value at maturity. So this is what we have. Now, I want to conclude this video by teaching you about the incredibly powerful relationship that is shared between the coupon rate and the yield to maturity. Exploiting this powerful relationship allows us to determine a bond's trading status incredibly easily. Perhaps more importantly though, this relationship will actually become significantly more important much later on in the course when we look at estimating the yield to maturity from scratch. Now the relationship is this. If the yield to maturity of a bond is greater than its coupon rate, then the price of the bond will be lesser than the par. In other words, if the yield to maturity is greater than the coupon rate, then the bond will trade at a discount. If, on the other hand, the yield to maturity is lesser than the coupon rate, then the bond will trade at a premium. In other words, the price of the bond will be greater than the par value. And finally, if the yield to maturity is equal to the coupon rate, then the price will be equal to the par, so that the bond trades at par. Again, this simple but incredibly powerful relationship is something that we're going to exploit when we look at estimating the yield much later on in the course. Alright, hopefully all of this makes sense. In summary then, we learned that bonds can trade at a premium, par or discount. Generally speaking, premium bonds tend to be less risky and discount bonds tend to be more risky. Importantly, we learned that all bonds, regardless of their trading status, will always converge to their par at maturity. Finally, we learned this incredibly powerful relationship between the coupon rate and the yield, which we can use to determine a bond's trading status, but also, as you'll see much later on, we can use this relationship to help in estimating the yield significantly more easily. And as you'll go through the course, you'll also find that this helps us identify undervalued or overvalued bonds. Alright, that's enough from me for now though. Have a go at the quiz and I'll see you in the next video.